whatever it is, you want to make sure that one of the things that you don't do is have to worry about your retirement or, heaven forbid, unretire. And so hopefully things that we talk about this week on the show can give you some pointers into that. So let's go ahead and talk about something here that is pretty interesting, guys. One strategist at JP Morgan says he believes the market is going to retest last year's lows in the coming months, which would mean a drop of another 3,000 points or so. Look, I know that nobody has a crystal ball, and you should certainly be wary of anybody who does in their office. But if people hear this and they're losing sleep over a headline like that, what do you want to tell them? What should they do?
Well, I think, when you wake up and you look at the news, there are going to be headlines all the time. You have to realize that, news is designed to sell based upon emotions. I mean, we've been on the radio for over 20 years now. But if you're worried about this, I think what you can do is you can turn this maybe panic, if you will, or thought of losing sleep into actually creating an opportunity. I mean, if we go back to the basics of investing, you buy low and you sell high. So what I think is a good idea here is I'm going to give you 3 tips and 3 ideas and talk to you about, how to attack a decreasing market. First of all, I think what you want to do is, number one, is look at, do you have a long-term plan of being invested? So when we get together and we walk people through the independent income system, one of the final buckets that we have is our long-term care bucket. Chaz, I know we had a client that we met with just the other day, and what we had talked about the first 3 buckets were buckets designed to provide income for the next 10 years. And so his long-term bucket was really designed for money that he didn't need for longer than 10 years out. So by having that bucket and knowing that it wasn't money he had to touch for 10 years, he really doesn't have to worry so much about, what's the market going to do next week or next month. He had time on his side. There's a great article by Warren Buffett. If you haven't read it yet, it's Buy American IM. And what it talked about is an article that Warren Buffett wrote back in the crash of 2008. And short term, the market continued to go down, but long term, that turned out to be great. So long term, timing isn't that big of a deal. Number 2 is, I would say, step left, not out. And I give you another example. I had a client that came in. She said, I can't stand this administration, what's happening with the economy, the market. Until this administration's gone, I just want to get out of the market and be done with the market. And the challenge about that is you're physically locking in, if your account's down, any declines that you had. So like in 2022, if your portfolio is down, if you go to the sidelines, you're not playing the game anymore. You're out of it. By going left, what we're able to do is we're able to show her a couple of different strategies that allows her to participate if and when the market recovers, but be able to kind of reduce or even eliminate, the downturns if the market went down. So we use things and talk to her about things like what's called buffered ETFs. Also, things like fixed index annuities can help you draw a line in the sand that says no more negatives. Look to participate moving forward. Number 3 is, I would say, buy at a predetermined point. If the market drops, say, 15%, again, buy low. If the market drops more and it's down 25%, buy more. So just think about the basics of investing. It's simple. Buy low, sell high. And I also think that if you're having trouble sleeping at night, this is where we want to help you sleep better at night. And I think working with a financial professional can help you hold your hand and turn what may seem like a panic into an opportunity. That would be the advice that I would give. How about you guys?
Yeah, I would agree. I would say what you're referring to is upgrading quality. And so it's important during recessionary periods of time when the market's going down, first of all, not to panic. Make sure you don't do any knee-jerk reactions because the market is cyclical. We can say for sure that we've personally lived through 3 or 4 market downturns. We've recovered every time. And oftentimes when we look back, and when I personally look back, I'll speak for myself, those are some of the best buying opportunities we've ever had. Think about COVID, for instance. It was a scary time, but it really was a great time to be buying. And so I think what you can take comfort in a down market is that some of these bellwether stocks, some of these companies, we call them blue chips because, we're poker players, out there, if you're any listening, the blue chip is usually the most expensive chip on the table. And so those are the companies that you want to own. And that's what I mean by focusing on quality in a downturn, that you can pick up some of the companies that have traditionally been overpriced because they've skyrocketed up over the years, but maybe now they're down, market's putting a low price on them. We don't have to accept that price. We'll come back tomorrow and we'll see what the market's going to offer us for our stocks then. But upgrading quality, upgrading stocks maybe from what you have, what we call flyers, to the companies that have strong financials, that have little to no debt, stable earnings, solid management, I think is a good strategy. So don't panic. Focus on upgrading quality. And also consider dollar cost averaging, just kind of going back to some of the blocking and tackling when you're faced with challenges. Your training, I think, as an athlete, everybody here on the table knows that when you're faced with adversity, that's generally what you refer back to as your training and your knowledge. And so dollar cost averaging is the process of buying in increments over a period of time instead of trying to put all your money in at one time, and you lock in that price point. And to Nolan's first point, when you're selling, if you decide to get out, completely out of the market, what do I always say? You have to be right 2 times. You have to be out right on the way out, and then you have to be right on the way back in. Otherwise, you're toast. So I think those 3 things are important to take away. Don't panic. Focus on upgrading quality, and consider dollar cost averaging into, and I'm going to say also out of the market. So if you're really dead set on getting out and reducing equity, sell in increments maybe into a down market, and then be willing and prepared to buy on the way back in.
As the great Kenny Rogers, late great Kenny Rogers once said, you got to know when to hold them, you got to know when to fold them. And any financial plan worth its salt is going to know there is going to be market fluctuation over the course of your 20, 30-year retirement. If, the past couple of years have been a wake-up call for you because you just thought, or your advisor just thought, that the market was going to do nothing but go up, well, it is certainly time to reassess that, and there's no better time like the present. Give a call to the team at America's Retirement Headquarters. Let them show you, how to turn these situations of financial duress into, possible opportunities. 419-794-3030 is the phone number. You can also go to the website, arhq.com.